Investing in the stock market has become increasingly accessible to everyday people, and for good reason. Whether you're saving for retirement, building wealth, or planning for a major life goal, the stock market offers unique opportunities that can help you reach your financial dreams. But before you dive in, it's crucial to understand both the remarkable advantages and the genuine risks that come with this investment avenue. Let me walk you through the pros and cons so you can make an informed decision that aligns with your financial goals. If you're interested in building wealth and making smart financial decisions, subscribe to the channel for more insights on investing and personal finance. Now, let's start with the pros. The most compelling advantage of investing in stocks is the potential for long-term wealth accumulation. Historically, the stock market has delivered average annual returns of around 10% over extended periods. That's significantly higher than what you'd earn from a savings account or a bond. When you invest early and stay committed to your strategy, compound interest works in your favor, turning modest initial investments into substantial wealth over decades. This is why financial advisors consistently recommend starting your investment journey as early as possible. Another major benefit is accessibility. Today, you don't need a fortune to begin investing. With fractional shares and low-cost brokerage accounts, you can start with just a few dollars. This democratization of investing means that more people than ever can participate in wealth building that was once reserved for the wealthy. You also gain diversification opportunities. Rather than putting all your money into a single investment, you can spread your risk across hundreds of stocks, sectors, and even international markets. This spreading of risk is fundamental to sound investing strategy. Additionally, stocks offer liquidity that many other investments don't. If you need access to your money, you can typically sell your shares within moments. This flexibility is invaluable when life circumstances change. You'll also benefit from dividend income. Many established companies pay dividends to shareholders, providing you with regular income while your investment continues to grow. It's like getting paid to own a piece of a company. Furthermore, the stock market provides inflation protection. Over time, stocks have historically outpaced inflation rates, meaning your purchasing power actually grows rather than diminishes. Now let's discuss the cons, because investing isn't without its challenges. Market volatility is perhaps the most obvious drawback. Stock prices fluctuate daily, sometimes dramatically. If you check your portfolio frequently, you might see significant gains one day and substantial losses the next. This emotional roller coaster can be difficult to navigate, especially for beginner investors. Risk of loss is real and significant. Unlike guaranteed savings accounts, there's no promise you'll get your money back. You could invest $1,000 and see it drop to $800. For some investors, this possibility is simply too stressful to bear. The stock market also requires knowledge and research. While you don't need to be a financial expert, successful investing does demand that you educate yourself about different companies, sectors, and investment strategies. Time and effort are required to make informed decisions. Additionally, the market can be influenced by factors beyond your control. Economic downturns, political instability, company scandals, and global events can all cause stock prices to plummet suddenly. You might do everything right and still lose money due to circumstances entirely outside your influence. Transaction costs and fees can eat into your profits. Even with low-cost brokers, fees add up over time, particularly if you trade frequently. The temptation to panic sell is another psychological challenge many investors face. When the market drops sharply, fear can override logic, leading you to sell at the worst possible time, locking in losses rather than waiting for recovery. This behavior, repeated across many investors, actually intensifies market downturns. There's also the danger of overconfidence. New investors sometimes feel invincible after a few successful trades and take excessive risks, ultimately suffering significant losses. Finally, not all stocks perform equally. Individual stock selection is difficult. Even professionals struggle to consistently beat the market, so the odds are stacked against you if you're trying to pick winning stocks on your own. So how do you weigh these factors? The answer depends entirely on your personal circumstances Your age, financial stability, risk tolerance, and investment timeline all matter greatly. Younger investors with stable incomes can typically afford to weather market volatility and benefit from long-term growth. Those nearing retirement or with limited emergency funds might prefer safer investments. Many financial experts suggest a balanced approach. Rather than trying to pick individual stocks, consider diversified index funds or exchange-traded funds that track broad market segments. These vehicles offer the upside potential of stocks with reduced single-company risk. Dollar cost averaging, where you invest a fixed amount regularly regardless of market conditions, can also reduce the impact of volatility. It removes emotion from the equation by making investing automatic and systematic. If you found this breakdown helpful in understanding the stock market better, please like this video. Your support helps us create more financial education content. Remember, the best investment decision is one based on knowledge, honest self-assessment, and a clear understanding of both opportunities and risks. The stock market isn't inherently good or bad. It's a powerful tool that can build tremendous wealth when approached with discipline and realistic expectations. What's your primary reason for considering stock market investment? Share your goals or concerns in the comments below. I'd love to hear what's driving your interest in investing and what questions remain. And if you want to continue learning about personal finance, investing strategies, and wealth building, please subscribe to the channel. Thank you for watching, and happy investing.